Good morning, everybody. Hope you guys are doing well today on this beautiful Wednesday, rainy day in Knoxville, Tennessee.
Yeah.
With me is the mentor, the man, the godfather of options, Mr. Dan Sheridan. Dan, how you doing? In Finland this morning, still in Finland.
Still in Finland, and we'll have to bring you back, Troy. Some of I know they're known for their chocolate. They have good coffee. I've been going to this in the morning to get a little exercise. I go to this. There's malls everywhere here, and have the Turkish coffee, and they give you cookies with it. So it's nice. He doesn't understand a word I'm saying. I don't understand a word he's saying, but we just kind of smile at each other and drink. We drink together the coffee, and
cookies are the universal language.
Oh yeah, it's nice. Yeah. He brings in a little cup and everything, but
I love it. I love it. I think we need to add to the show. We're gonna have to add Finland to the blues. So we'll watch and figure a place to put it in.
Yeah, that's it. Yeah.
Back. Troy's dreaming big like LeBron. Matt's backtesting like a daddy Mac. Dan's 30 years got our way, trading life and markets every day. Rusty's chained to the mines, digging deep day by day. But when features, he's free to come out and play option. Omega, you're trading home, where every move makes you feel less alone.
Markets in turmoil, Dan.
Oh yeah, turmoil.
Markets in turmoil.
Baby turmoil. Yeah, I mean the futures are, as you were talking last week, you and Matt a little bit about the wrestling match in the futures at the 5,500 level. That's basically what we've done here. Is we've kind of gone over it a little bit the last few days, and now we're at 5,504 as we speak. Down 78 points. So I'm sure there'll be some wrestling there. What do you show in the profile around that area, Troy? Still?
Yeah. So if you look at, can you see my screen?
Yeah.
Okay. So I mean, we're well out of yesterday's range, and we're into the day before's range. We're at the bottom of today, Monday's range. So, I mean, if we continuation would be like 54.80 would be. Okay. The bottom of Monday's range. Once you're doing that, if you remember, we're well back into that 5,500 range at that point, and then all bets are off after that. So I think they definitely want to. I think about it with market profile in terms of what do they need to do for something else to happen, and they need to get basically below 5,500. If they stay above that, then all of this previous couple days, is back in play. But
yeah, and I mean it shows VIX maybe getting up to 26.5.
Yeah,
and we'll see. I mean, I think it's tough for people to play this. When you saw VIX hit 24, whatever yesterday, historically you're not used to buying at that point.
Yeah,
with stuff still on the table. You can have a higher range. Like in 2022, the VIX range was maybe 18 to 31. So, that 24, I know some people who were buying some VIX call verticals yesterday at small size, kind of scaling into it, because that's been the low for a few good weeks here, right? I think, I don't know if it was 3 or 4 weeks, we briefly hit 17 in the VIX, but yeah, today looks like it'll be a couple points up as we're kind of, hugging around that 5,500 level.
It's Dan, I had a question. Some people were talking in the Option Omega Discord the other day, and I glanced at it, so I could be missing their question totally. But they mentioned asking you, did market makers, did you guys all know each other's positions, or was there any type of secrecy to the positions?
Well, here's the truth. We were, it's almost like if this could be one of my worst analogies, so bear with me, but if I'm like a seal or whatever fish in the water and prey comes, we're all eating the same thing. We all know the story. And so when you're in the pit, let's say when I was in the IBM pit or Micron pit, there's 40 market makers in there. The system is basically you have a specialist, which is 2 or 3 people. They're responsible for the pit. And then you have 50 market makers or whatever. And the specialist can get half the volume, half of the order flow, and the market makers split the rest. But Troy, you got me going. You're going to have to see as you hit 65 years old, you can start talking. Someone asks you a question, you start answering it, and then you got to go back and say, give me the question, because I was going to give you.
I love that. Are people secretive of their positions?
They may try to be, but they're not. Because here's the thing: when you're in the pit, your inventory for the most part is all the same. Some guys, like when I was in the pit, Chicago, if Goldman Sachs came in and sold 20,000 calls, we all bought them, whether we wanted to or not. So we had this inventory. So if I wanted to get out of those, I couldn't get out of them with the guys in the pit. They had the same position. They go, no, I'm not letting you out unless you, if you're panicking. So I'd have to pick up the phone and call, with my quiet voice, the San Francisco Options Exchange or the Philadelphia Options Exchange. Hey guys, because we got the order, they didn't. I'll sell you 50. I want to unload my inventory. But now some guys would, some people would have a little bit different, but for the most part, we were all, we were eating on the same food, right? So, and that's kind of it, right? It might change a little bit now, but you couldn't, in rare situations, could I turn to the guy next to me and unload? Let's say I had a ton of long Vega and a ton of long Theta, and or negative Theta, and the market's just slow, and I'm getting killed on it. The guys next to me are getting killed too, right? So it's like I can't lay it off on these guys. So you're kind of in it together, even though you have different positions. One quick other thing, in the pit, and even now, some guys weren't as comfortable, believe it or not, with volatility. Some guys were just scalpers. They would be big guys. They'd hire football players sometimes, and they say, look, you're going to buy in the bid, sell on the ask, because who would get the business is who was the loudest or who was the most aggressive. Now it's all on computer. But, they would tell, especially people, if you're not really comfortable with volatility, stick with the front month, buy the bid, sell the ask, scalp, try to make $1,000 and go home. Because once you go 6 months out, as you know, and you get long or short volatility, if you're wrong on your assessment, as Mr. T would say, there's pain, right? So that was more, most firms didn't let you make decisions more than 1 month out unless you were really understood volatility, because that's where you could get killed, right? If you took 2,000 contracts from Goldman Sachs, if you sold low vol and they bought low vol and then expanded 20 points and you lose X amount of dollars, you can lose your job. So, but anyways, to make a long story short, they're kind of, and I would think it would be similar with the electronic trading, because they're taking, again, remember what the function of a market maker or specialist is. They're a wholesaler, right? So they're taking inventory and try to turn it into something good, but they're taking the opposite side of the public. So they're, in a sense, what they're doing sometimes, you think about it, when people are selling volatility in the last couple of weeks at VIX at 35 or 40, you might think, well, who are the idiots buying it, right? The idiots are not idiot, but people in the pit. But there's also speculators that think the vol's going up. So it's anyways.
No, that makes total sense.
But yeah.
No, that makes total sense. I appreciate you answering it. One more. I mean, we're just doing question and answer today before we get into some tests. Tom's a friend of the show. Tom asks, why buy VIX verticals when you could just buy SPX puts to long Vega? So why basically? Yeah, he got it.
I mean, that's a good point. I mean, you could, it is related. I mean, you could, if you think VIX is going up, you could buy calls in VIX, you could buy call verticals. But if you think VIX is going up, that's a definitive statement on where the market's going, right? You're not saying I think the market's going up, you're saying the market's going down. So you could buy out of the money puts or out of the money put debit spreads or butterflies or broken wing butterflies near the expected move type thing. So absolutely, I agree with that assessment in SPX or yes, I agree with him. You could go either way.
And Tom, I would just go ahead there.
I don't know I wouldn't say one is better, but he makes a good point. I'm sometimes VIX can act a little funky on the pricing, and you could go buy. The way I look at VIX is if I'm buying verticals or buying calls, I look at it as okay, how much am I willing to bet on this thing? It's a spec bet, right? I'm willing to bet $2,000 or $3,000 or whatever the number. SPX is a little different. I mean, you could as long as you approach it the same way, because you could get a lot of deltas real quick in there, and you want to make sure it's the same attitude. Hey, I'm going to go buy some puts in the SPX. Well, what are you willing to lose? If you go buy $3,000 worth, what if you're wrong and the market goes up? So
as a amateur, someone who considers himself an amateur tail hedger, I would just say to Tom, why not both?
Well, yeah, why not? And the key is, if you're going in, again, I think, when you think of people that sell naked options, right? Oh yeah. And people do it maybe in a portfolio margin account or a SPAN account or whatever. Nothing wrong with that. But if I don't do it, but the main thing is this: what they don't miss is I'm not, in those short put positions. I'm not even that scared of I'm more scared of the volatility than the price move, right? I mean, the price move, you can kind of look at it and say, okay, we go down, and in our nice, clear every world where everything works out real nice, we say, okay, when the put goes here, when the market goes down and the put goes here, I'll get out. But what if the market goes here and VIX goes up 70, 80%, right? Are you going to go buy that back? Are you going to buy back your $3 option when we gap down and the VIX goes up? And Troy, you could, you know as well as anybody, the last 3 weeks when that happened, do you really want to buy that put back? So if I'm going to go in and buy some tail stuff, I'd rather just buy the puts, or in a lot of cases, or maybe a call in the VIX, just because if something explodes, I'd hate to have a spread on it, right? Because that's, you're selling volatility, you're buying volatility, but like you do, Troy, I think, right, you'll get some of those tails. And the other thing is this: we're not in that situation now, but think of the phrase, folks, buy when you can, not when you have to. And I think you could do it on a regular basis. There's nothing wrong with that. But, when VIX was 17, not too long ago, right? Or less, those are times where maybe you go out and buy a little bit further duration, right? Because that's the thing. We don't know when the move is going to hit. So you might, if you're too close of an expiration, you're going to have to keep rolling those. But I mean, if you get a nice volatility level, I don't mind going 4 or 5 months out and just kind of waiting. What do you do, Troy, when you're looking at tails trades? How do you handle the duration? How do you do that?
I'd be a lot richer if I could handle the duration, Dan. I mean, that's honestly, that is I'll start. So in a blank market, I will start looking 60 days out. I want vol for a couple months out, because obviously the decay is tough, to have something and then, 3 days to expirations when it happens, you're just too far away.
You're too far away, right?
And so, so those things, starting with 60-day, the Liberation Day stuff was just totally different because it was so binary, it's just he's making an announcement. And so I think if you think that vol's going to explode eventually and that we still are underpriced, right now, I would look at like farther dated out stuff in some ways. Like I get past May because you think about they're going to try to. I haven't looked at the skew, but they're going to announce in May more tariff or June or something like that. It's the 90-day pause. Well, that May, June, I think a lot of people are still maybe have some hopium that it's going to resolve itself by then.
Yeah.
So if you don't think it's going to resolve yourself by then, maybe buy some cheaper vol farther dated out when they think that it's already going to be resolved with them. I don't know.
No, that's a good point because that is going to be, you're going off what he said, which is 90 days. But as you know, like a riverboat gambler, his 90 days could turn into 120. His 90 days could turn into. So I think playing those skew curves or something could well be worth looking at. But well,
it's
interesting.
I mean, there's two. Listen, I could talk about tail hedging all day. It's my favorite thing. But two things to discuss today. One, a very live show tomorrow for the first time in history. I would have to imagine 3 people. One person's going to be in Indianapolis, another person's going to be in Finland, and another person's going to be live at the Watergate Hotel.
Say no more. Yeah.
Doing Option Mega Show. So I'm very excited for that. 2, we are going to continue this morning for a couple minutes just to look at 2 tests. What we've been doing is we've been talking this week about butterflies that you receive for a credit to the upside. So upside broken wing butterflies for a credit. And we've got 2 more to look at today. And Dan, if it's okay, I'm just going to go ahead and do it. So yesterday we looked at a trade where you had a gap up at 932 on gaps up of 1/3%. If we open up 1/3%, we put this on. Well, we switched it and the results are much better. Instead of doing that, anytime intraday that we are up 1/3%, 0.33, we will put this on. What is this? You're buying a call for 50 cents 1 day out. You're selling 3 calls for 25 cents 1 day out. And you're buying 2 calls for as cheap as you can 1 day out. And this has worked really well. I mean, those are the graphs that I kind of like to see, and 261 trades is a pretty good data set. I mean, for 3 years, I mean, that I've seen worse. And, this is something to me where this is now getting into the range of like, okay, this could be, you could definitely filter it more, but this definitely feels like a good strategy. Dan, as I look through it, I mean, what you're doing basically is this is a class, April 24th. So last week, price is at 54.01. We move up. So in the morning session, we just go up. We go up 1/3%. So at 9:47, remember price is at 54.01. We're buying 4 of the 5680s. So 280 points away.
Yeah.
You are selling 12 of the 5740s. So you've got a 60-point range in that.
Yeah.
And then it's synthetically naked. But Dan, what do you think of that?
Yeah, I mean, I like the tweak you did, Troy, with the move up 1/3%, right? Because I mean, for a couple of reasons, but one is a lot of times we may shoot up and at the end of the day come back, right?
Yep.
Which you have a credit here.
Yep.
But the other thing is, even if we keep going, you want it eventually to go up, right? And so you want to get some momentum. You want to get some juice going to the upside. So I like 1/3%. Like, let's get this thing going to the upside, because you gotta, as Troy said there, what your initial long is 200 points up.
Yeah.
Right? And that gives you that's a nice move. I would think if you're buying that a half, would you say that's under a 5 delta, Troy? Maybe a 3?
Yeah, with that high VIX, I don't know what it would be, but it's low delta.
It's a low delta. Yeah, I think it's a pretty safe trade. I mean, the positive is, the win percentage, the results, and the test. A lot of trades there. I mean, the only not negative, the things there maybe if that might be troublesome to some could be this would eat up a lot of margin.
It's margin, and it's I mean, that last long call isn't helping you at all. I mean, it's only reducing margin. That's all it's doing. It's
and that's why you wonder, even if you could bring that in a bit, if that would, where's the leeway to bring it in a little bit? But that's about the only big negative. The margin, the margin is the biggest hurdle.
Yeah, and I could see. I mean, again, giving you guys, if you want to test at home, one of the things you could test is, can you collect more credit, load up on credit, or collect more credit, and then as soon as there's any down move, any reversion, go ahead and bring that long in, and buy it back and bring in your buying power reduction. Does that make sense?
Yes.
So how you test that is, obviously you can't test all that, but what you would test is collecting more credit and then testing at a 5% exit or like a 3% profit exit, and see how many times that happened, because that usually means mean reversion. Yeah. And then maybe start to think of a game plan as, on a 3% profit target, I'm going to move my super long far away call in, and making it closer to a risk-free trade.
Right. Yeah, it's right. It's something you could work with, right? I think, and part of it is just getting used to that, like what you just mentioned, Troy. If we go down, move that long in, and kind of rinse and repeat type thing.
Yeah.
But very interesting. It's a good trade. And
just that margin. I'm with you on the margin thing. I mean, Dan and I were talking off the record, like, the key to this, and we'll say this with like every trade, every strategy we ever do, is the key to this is risk management.
Yeah.
And how do you manage risk? Well, you want to remove the risk as soon as you can.
Yeah.
And you never want to size disproportionately. So, which, Tom, great question. Thank you. You gave me the question I wanted. Troy, can you please tell me which broker you use that would give you the 1 DTE long call for 0? I may just load up on those every day for 100% win rate. Tom.
Wow.
Bless you.
Yeah.
Don't load up this strategy. Yeah. I promise you, you don't want to load up this strategy. Two, they're
Yeah.
not going to give it to you for free. Basically, what the test is doing is saying, go find the cheapest one,
Yeah.
closest to zero that you can.
Right.
And
Right.
that's what it's doing. So this is where the data is it's hard with those far out of the money things. So in real life, what you would do, I mean, when we put this into the backtester, and you'll be able to automate this, is you can set it to where you say $0 or up to this far away.
Right. That's okay.
And we're not testing that, but that will help you in real life if you traded this, automated this. So let's look at another one, Dan. Is that okay? Nope. Oh boy. Oh boy, Dan froze. I'm going to pretend that Dan is looking at me lovingly, but I have this feeling that the frozen Dan is looking at me sternly. So I'm going to go with he's looking approvingly to the next one. All right. Next trade. My partner's not here, so you guys in the chat have to help me with this. Can you see this? This test called interesting. You guys see it? Holler at your boy if you see it. Like and subscribe that. Can you guys see me? Okay. That sounded like I was crazy for a second. You guys weren't saying anything. I was just sitting there like, I was starting to Google things to see if the internet's working. Okay, anyway, we're back. So this test right here, this is a different thing. Okay, now you guys all see it. Thank you. All right. This is a different thing. And what this is we're testing now the ORB that we did last week. So same concept, same structure of a trade. It's a broken wing butterfly. It's a little bit different. This one's the 100-point out. But this is where this one's interesting, is people have said 1 to 2. I think there's a lag where now I'm just talking and I'm getting like 80 messages to say yes. So thank you guys. Shout out to the chat. Shout out to the chat and shout out to the lag in the internet. So this is the trade that basically says, okay, we're going to set a range. And the range is from 3, basically. Oh, Dan's back. Dan, can you hear me?
Yeah. Sorry about that. I think our internet just went out.
Oh, no. Oh, you're good. You're good. I just started the next chat. I thought my internet had gone out too for a second, so I needed. Dan, this one is a different one. So basically, you're setting our opening range from 9:30 in the morning to 3. So if we've been in a range from 9:30 to 3, we consider that a range.
Okay.
And if we break out of the upside, so if we break out a range after 3, we're going to have a 15-minute window where we put this on. And what is this? This is 100 points out to the upside, and it's a 5-day butterfly. This is just to show you that the structure can work for different durations. So you're buying 100 points out. You're selling 2 calls 10 points above that. And then you're buying the call 50 points above that. So if you look at this, you're collecting more of a credit for this one, usually, sometimes not. You could test this with the deltas as well. But this one's interesting to me because you're collecting more of a credit. But because you're collecting more of a credit, we are scaling out. So at 100% profit target, we're going to close 25%. At 500, we're going to close another 25%. At 1,000, we're going to close 25%. And if for some reason you make it to 2,000% profit, get out of Dodge.
Yes, quickly.
Quickly.
Yeah.
So Dan, I mean, again, the idea of saying this is a different duration, same kind of structure, different duration. Any thoughts about that?
I like this. What made you think? What was the thinking? I like this. The 5 days versus so you can. What was the thinking with the 5 DTE?
Crack cocaine.
Oh, good enough for me. Good.
Yeah, no. I wish I had a logical answer for that. I think I was testing, or this is something I've looked at last year basically, and then saved it. I was looking at orbs, the opening range breakout, and I thought, is there a way? Is a daily breakout? What does it mean to the upside for the next couple of days? And this is one of those tests, and this is the beauty of like data, like I talked about previous weeks, that I don't trust myself.
Yeah.
I have no idea why. If I could, this has been a minute since I've ran a bunch of tests in this fashion.
Yeah.
I cannot explain to you why 3-day doesn't work as good, or 7-day doesn't work as good, or 2-day doesn't work as good with this opening range breakout. Something about 5 days.
That's amazing. I mean, and it's, I just caught this with my eye. 44 trades, 44 winners.
Yeah. Now I did remove. Now one thing that you'll notice that Wednesdays are missing from this trade.
Okay.
Why? Well, because Fed days, I don't want to play on CPE days, CPI days, PPI days. I don't want to play on any Wednesday news days, because what happens is if you look a lot of gaps, like in the past 5 years, Jay Powell will get on there. He'll say something the market doesn't do. Maybe it goes up a little bit, but then Thursday it just absolutely rips.
Yeah.
I don't want to.
Yeah, this is good because you don't really. Yeah. So Thursday you get in Thursday, right? Unless you're already in by Monday or Tuesday.
Right. Is that in that case, there's nothing you can do. I mean, that's part of the data, but
I like this 5-day because you go with a, it goes with the trend a little bit, right? You got a little more room and a little more time than just a 1 DTE or something.
Yeah. Yeah.
That's what you had on the credit one yesterday, was 1 DTE, right?
That's right. Those were 1 DTE. This one is a 5-day, and you think, well, man, it could blow past, and it could blow past, and that's why you have to size it accordingly.
Right.
But 44 trades is not a lot. So you have
I was just going to say that. Yeah.
You can't, I wouldn't trust a lot of it, but the theory hold. The nice thing about these, Dan, is they're very forgiving if you're not greedy.
That's right. Yeah.
The moment you become a little piggy, the little piggies are going to, get slaughtered.
Right. And I like the scaling out of this with the exits. And that'll keep things a little more sane. Yeah. Both good tests. Again, they're both of them have the same kind of negative margin. This isn't obviously as bad as the other one with margin because it's a little tighter. But yeah, these are good. And I want to encourage folk, a lot of these tests, most of the tests, it's almost everywhere that we've been doing in the show, they're good trades. And I think that pick one every, pick one, stick with it, and get used to it, right? Once you do it 2 or 3 times, you get used to how it feels, the flow of it and stuff like that. And these are good trades, and especially in the environment we're at where things could potentially, we could have this type of trades, we could have another, market's still down 10% from the high.
Oh, yeah.
And if we're going to recover, 10%, that's another 500-600 points.
Yeah.
So these are these trades are relevant now. And, as we speak, ES is just kind of hanging at that 5,500 level. But yeah, I think these are these are good, and I would encourage, and I know that's Troy's heart wish too, is that you take these tests, folks, and make them better, right? Try to come up with some tweaks to improve them, and that's the fun part of trades, isn't it? When you come up with something and someone makes the chair a little bit better.
Oh yeah, no, I think it's no doubt you guys will make it better. I mean, you guys do that all the time. This is the OO crew who likes the back tests, they're masters. So, but I like that. But you might think I mean, I will say this: we're going to talk about this more when we do a full launch of automation. There are ways to do this with a smaller account. That, in my mind, I'm not against MEIC. Like, I'm not against selling a bunch of tranches. I think that's a great way to learn as well if you have risk management. This is a good risk management if you do a one lot.
Yeah.
Because it teaches you a lot about Greeks really fast. How can something that opens for a credit expand into more credit?
Well, and I also think these are the strategies yesterday and today, Troy, are good because the Greeks keep you a little more grounded because these are short delta trades, right? And we want, and it's kind of, until you understand the Greeks, or until you get used to the Greeks, I should say, you're starting out short delta, but from the expiration graph, you want it to go up, right? But you don't want it to go up necessarily too quick, right? So I think it's important to get on these strategies that, the expert, your to me, the deltas at the day one, right? That'll tell you, okay, I'm short deltas today. I'd rather it go down. But if you look, as you get 2 days in the future, 3 days in the future, 4 days in the future, hey, boy, if this thing goes up, it looks great. So I think, that's why I think it's important to learn the Greeks and learn how do your Greeks, everybody should get used to this. When you look at a graph like this trade, I would encourage people as you model it, how does this trade look in a day, 2 days, 3 days till expiration? And then you could see how the deltas and everything move, kind of a 3D type, get this in your mind. So yeah, I think these are, enjoyed the last 2 days of trades. These are good.
Well, on that note, I hear children frolicking in the background, Dan. So I'm going to let you return to the more important
frolicking is too kind of a word.
So if you find one of them saunas to bring home to me, let me know.
I will.
And
yeah.
With that, guys, have a great day. Lord willing, I will see you from